In today's video, I'm going to talk a little bit about Rule 263, market taxes, aka losses, are greater than government taxes. When people get into financial markets, they immediately think they're going to bank a lot of money. They're very concerned about government taxes. However, they need to be concerned about their knowledge. Government taxes are always optional, but market taxes, losses are compulsory. By way of analogy, a lot of people think when they get into boxing that they're never ever going to take a punch. And of course, this is absolute rubbish. When you get inside a boxing ring, yes, you're going to take a punch. It's exactly like what the markets do. When you take a punch from the markets, you've suffered a loss. When you dodge a punch, you get a profit. There's definitely a lot of money to be made in terms of boxing. When we look at the all-time richest boxers, Floyd Mayweather did pretty well, $400 million. George Foreman, $300 million. People often look at the outcome and just forget that there's a lot of steps in between. There are 4 zones that each and every trader and investor progresses through to make consistent profits and attain emotional mastery. And emotional mastery is really important. For example, a boxer afraid to take a hit will not master the boxing ring. Inside Zone 1 and Zone 2, this is akin to a boxer that is just fresh out, looks at $400 million and says, "I'm going to make that, but I won't take a single punch." This is absolute rubbish, but there's no shortage of scammers out there that will tell you it's possible. It is not, unfortunately. Having been inside financial markets for nearly 4 decades, my job is to help you to get realistic on the markets. You can absolutely make a fortune, but you've got to know the rules. Other people's outcomes are not the issue. Rule 266, trading minimizes market taxes. I'm going to get really practical on the minimization of market taxes, which are of course losses. It's like you get hit inside the boxing ring. There are specific ways that you can minimize your losses. You get in the boxing ring, you are going to take a punch, but overall, if you come out ahead, you're going to win that bout. In this video, I'm going to get really specific on how you can use trading to enhance your investing career. And it is a career. You need to look at the long term when you're investing, and trading is absolutely the way to get timing inside the markets. Timing really matters. Let's run the numbers. Hi everyone, I'm Ken from CryptoTradingKS and the CTKS Method. If you're new, a very warm welcome, and welcome back, CTKS family. A lot of people say that you can't time the market. This is not actually the case. My goal is to help you to be more of a financial and emotional blessing to yourself and those you love. When we look at Bitcoin overlaid on the VIX, what we can see is right up here, Bitcoin was around 106,000 and it's currently down to 94. It went as low as around that $76,000 mark. Now, why was this the case? Basically, it was because the VIX grounded out and found a base and then started to rise. VIX is a very important measure of fear inside the markets, and the fear is not just in the stock market, it's across every single market, including crypto. To avoid paying knowledge taxes, you must keep your eye on the VIX. It is really, really important. As the VIX goes up, you will find that everything comes down in terms of risk-weighted asset classes. So the stock market and also crypto will be taking a dive when the VIX starts to just push itself up. Now, what I've done is to just invert Bitcoin because it gives you a better indication of what the directionality is. What you can see is when we inverse Bitcoin, and inversion is just the big number is on the bottom and the little number is on the top. Pretty easy, really. Now, when you see the VIX spiking up like this, That was not the problem. What the problem was the VIX was basing, so fear was starting to creep into the markets after coming down for an extended period of time, and that caused a likelihood and probability that the VIX was going to shoot up. That's actually what brought Bitcoin down from 108 way down. If you were keeping your eye on the VIX throughout this time, you knew that, and you could take advantage of the great sales that were inside the market. Now, how do we use this on a daily basis? Remember, the concept is to avoid the market's taxes, knowledge taxes. In yesterday's video, you could avoid a few punches to the pocket if you looked at the VIX futures. For example, I was explaining that the VIX futures had a lot of underpinning structural support and they would likely to bounce. Now, what I'm going to do is just to show you an inversion on this scale, and I'm also going to show you the structure. Both these things are very important. In yesterday's video, we were just here, and I was suggesting that because of this structural support in at that 2339, we were likely to get a kick up. The first area that we needed to look at was between 24 and 24.25, with higher levels absolutely on the radar, but this was the critical one to observe. When you get a structural pass, it will go to the next level of structure, interact with it. If it fails, it's coming back to the lower level of structure below. Now, what does this mean? Bitcoin is an absolute expert at sniffing out risk on or risk off inside the markets, and we saw a lot of risk off. Now, I'm just going to uninvert that scale because a lot of people relate to this better, but I want to show you the directionality. So, as the VIX was coming down, Bitcoin came up, but as it started to base, things started to get wobbly inside the crypto market. Why? Because of the VIX basing and also coming into structural support. You can see all of this structural support in here. It is really significant, and we know ahead of time where that support and also where the resistance levels are. More importantly, how important they are. If you get a lot of bunching like this, that means that the probability is that it will kick up. You can see that it did kick up, retested, and then went nuts. Now, what happened as the VIX spiked up? What happened to Bitcoin? It sold down dramatically. If you were looking at your VIX futures chart all marked up with the CTKS method, making sure that you cover all of that time period with level 1 and level 2 standard certification, you would have known it bypassed here with a structural pass, had so much power, but this actually makes a tremendous amount of sense. Why? The reasoning and logic has to do with the main VIX, not the futures, just the main VIX, and this VIX operates inside trading hours of US sessions. This main VIX had been coming down and down and down and down and was starting to base itself. Now, what does that mean? If we see a basing, it could flick up, and that's a probability that we must be aware of. Don't be like the boxer that comes out of the corner and says, "Oh no, you can't throw a punch at me. I'm not here for that." Come on, you're a boxer. And that just means that you're going to take your punches. We take financial punches inside financial markets. But when you become really experienced, what you're going to find is you'll take punches far less. You'll see the punches when they're coming and you'll say, "I'm sidestepping that." Now, it's a bit of a different analogy to the ones I typically use, but you must be aware that the VIX is basing, the main VIX is basing on a longer term basis. Now, this could lead to two principal things. When the VIX bases, we usually get an area of consolidation, so the markets could get rather choppy in this zone until we break out one way or another way. If you read the mainstream media news, the only way this could possibly break out is to the upside. And the news is fantastic at determining turning points in the market. I'm joking with you, it's useless. Our solution is really straightforward and incredibly simple. Just stack probabilities like the institutional investors and traders do, follow inside their footprints and move with the institutions, becoming an institution of one. That way you can let the institutions take the punch. For example, if you were just looking at the institutional footprint of risk, which is measured through the VIX, the main VIX and the VIX futures, you would have known that this area was significant. We were basing, and basing typically leads to an uptick. An uptick in the VIX will bring risk on asset classes down to earth. And that's perfect for any investor and trader who takes advantage of this volatility. And volatility is not your enemy, it's the only thing that makes you money. Another way to avoid knowledge taxes inside the markets is to understand the structure of the charts that you're looking at, especially across the cheat sheet. And when we look at US oil, one of the things that I do inside the service is I produce CTKS paths on all 32 charts inside the service. It's a huge amount of work. And it's done with level 2 standard certification, which means you build on top of level 1. But the idea is when you know the structure inside the markets, you can get a better understanding as to where things are going. Now, US oil is currently coming down, but you can see this basing action. When the VIX spiked up, US oil came down, but when the VIX found its footing, US oil recovered. Therefore, we want to always look at stacking probabilities across charts. Literally, the more charts that you stack, the greater the probability is that you can figure out which direction the market is going in your time zone. If we see, for example, US oil starting to come down and down and down, that would indicate that the VIX is spiking up. What is the result of that? Well, you saw last month, or at the start of last month, and these paths are drawn at the start of the month and not changed throughout the month. If we see US oil starting to dive again, that would mean the VIX is coming up. If the VIX is coming up, that would mean Bitcoin and the stock market is coming down. In all likelihood, gold would be increasing. And also the euro dollar. There's a lot of things that you really need to pay a lot of attention to. And don't forget, you work so hard to create the money that you put in to your trades and investments. You should work hard enough to keep it and to grow it. It's always important to read the news, and I do bag the news a lot, but there's a lot of signal inside the news as well. But you can't trust the direction. For example, when oil a couple of years ago was absolutely going nuts, everybody was saying oil is the thing to get into, and we were saying, you better get out of oil. And shortly after that, oil started to plummet down. When everybody is feeling a certain way about the market, that's typically when the market changes its nature. Institutions don't want you to get too comfortable. There's a lot of rules that can guide your financial future. Please let me know in the comments, what are your favorite rules from the CTKS rules that I've shared? Financial markets are incredibly complex. They're also intercorrelated and interdependent, so it can get really overwhelming. And a lot of people do not have financial backgrounds and finance degrees. So it becomes really difficult to interpret what the hell are they talking about. The beautiful thing is you literally don't need to worry about it. Look at the charts. The charts always lead the news. These are just particular news headlines from the past 24 hours. You can see that they're pretty negative. And if you're making your buying and selling decisions based on news headlines, I would suggest that's not the way to go. Now, why is that? Because you will find some news headlines are very negative, others are very positive. But by the time you react, in all probability, the move will be gone. That's why, over many years that we've been doing these videos, I'm trying to help you to become an institution of one. Move with smart money, don't get stampeded by it. Therefore, Rule 263 is really important. When you get a market tax or a loss, you must convert that loss into a lesson, what we call lessons. Don't worry about your government taxes. Government taxes are always optional. And remember, the institutions will always wrong foot you. There is no problem with being consistent. The vast majority of people are consistent in losing money. Why? Why is that? What is the first thing that people do? Well, they look at the news. They don't look at the charts, they don't look at structure, they don't look at intercorrelation, interconnection. They do not stack probabilities. They get hit continuously by the market and are just bewildered. Why is this happening to me? The key is, just with coffee money trades, it can be $10 per trade. Just go into a particular exchange and make sure that you're starting to minimize your market taxes by getting synchronized. When the market throws you out of the market, don't be thrown out. Just come back with coffee money. This will synchronize you in. As we've seen so many times, the market throws everybody out right at the bottom. And what is the bottom accompanied by? So much negativity in mainstream news headlines. There is absolutely no problem whatsoever in reading the news. I think it's a good thing to do, but you must be aware there's so much fear inside news. There's a very low signal to noise ratio. That means there's not much signal. It is there, but there's so much noise. And the noise tends to get very, very loud at the exact wrong times. It will take a considerable period of time for you to separate signal from noise inside the markets, inside especially news articles. So therefore, if you're trading with coffee money, you can scale it up later. Everybody wants to just go to that $500 million per year. Forget about it. What's really important is you're in a career, you're in a profession. So when you start to get synchronized in with the market, those taxes that you pay each and every time you put money into the market will decrease. And that is what it's all about. And then what you just focus on is minimizing those losses and maximizing the profits. All you need to do is to win more than you lose over time. That's it. Pretty simple. To use a boxing analogy, hit the other guy more than you get hit yourself. It's a very different way for explaining how the markets work, but please just understand, if you are dedicated and committed, if you focus on your learning, just focus on that. Do not blame. When you blame, you lose the lesson. If you lose the lesson, the markets will come back at you even harder. They will king hit you. They will decimate your portfolio. All veterans inside the markets know this. We just have to stay in and strengthen ourselves. This is not a problem. This is the market. I believe financial markets are the single best way to develop positive excellence. That is literally all the good stuff in life. At the core of it all is happiness. Financial markets will expose your fears. If you're fearful, you will know about it. Keep on stepping up to the plate and swinging at that ball. You will miss some, you will hit some. Over time, you'll hit more and more. I've gone to baseball. Please let me know in the comments, what do you parallel by terms or in terms of analogies? What do you parallel the markets to? We have such an incredible global family. Your sharing each and every day is just awesome. And if you're not part of our global family, please smash that subscribe button. You'll find that we're a very, very different community. We're a community of eagles, not chickens. To be all you can be in life, you must create courage and conquer and master fear. You do it for yourself, you do it for your loved ones and future generations. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again in the next video. Bye for now.